Welcome to Real Talk with Real Estate Pros, where we bring you exclusive interviews with the real estate experts. We'll delve deep into their journey to success and learn how to go the extra mile to serve their clients' wants and needs. Let's dive in. Here's your host, John Money McKinley.
Morning, everyone. Welcome to another edition of Real Talk with Real Estate Pros. I know it's been a couple weeks since we've been broadcasting. Just had a lot of changes we're doing with the studio, a lot of changes we're doing with the office, and making a lot of good things happen here to be able to bring more great information to everybody on what's happening in this ever-changing, crazy world of real estate and credit. As always, I want to thank you all for being here, and please do me a favor, like, sub, and subscribe, and share this with your friends. We really want to have a place where people can go to get a lot of great information about what's happening in the world of real estate, because we all know a lot of the stuff you see on the television is just a script read by actors, and I'm here bringing real people that are in the real estate industry, whether it's lending, real estate, credit, insurance, home inspectors, all across the board. But with that said, we've got a lot of great information going on, because I know I have gotten a lot of requests from a lot of folks over the past week. We know the Fed's dropped the interest rates, and there's also a lot of stuff happening in the world of credit. So with that said, I would definitely like to bring on my guest, Mr. Greg West. He is a regular here. He comes straight to us from the hidden mountains of Kentucky, where he's keeping the credit secrets well protected from any of the forces that are trying to stop him from helping people get the highest credit scores possible. Mr. West, how are you on this fine morning, sir, or where you're at afternoon?
Pretty good, bud. How are you doing? Glad to be back.
I'm doing fantastic. I appreciate you being here. And I know we've got a lot of stuff we're going to be digging into today with what's happening on the credit as well as what's going on with the interest rate. So with that said, please just introduce yourself to everybody. Let everybody know your field of expertise, and we will start digging into what's happening in the world of credit and mortgages.
Yeah, my name's Greg West. Been in credit restoration for 25 plus years. Started out as a kind of like the hair club, started out as a client, ended up starting my own business with it. So I've been where you guys are at. If you've ever had any delinquent credits, just stuff happens to people. And you can get a hold of me at 859-625-4546. And if I can't help you, I'll push you in the direction of someone who can.
I appreciate that, Greg. And just so everybody knows, I've been working with Mr. West. It's going on 30 years now, isn't it, Greg?
Yeah, I said 25 plus, but yeah, it's probably 30. Time's going fast, man.
Greg reminds me from time to time, he goes, you know, you're the only mortgage guy left in the business that I've been working with in the credit side of things since the last great mortgage meltdown we had not too long ago.
Yeah, from 2008. I was working with about 15 different mortgage guys. You're the only one that's still, actively around. Yeah.
When you find a field you love, and I get to help people experience the American dream of home ownership, I mean, I wouldn't do anything else. Well, with that said, I'd like to go ahead and dig into here. Let's go ahead and just give a little bit of information on what's happening, what the forecast is for the 2024 and beyond market in real estate in the Houston area where I'm at. You know, the folks that are here in real estate or in the Houston area know we've been very fortunate and had a very good economy. And a lot of the things that we're seeing happening in the state of Texas, we're seeing a lot of big industries move here. So a lot of what I'm seeing and the reports that are coming across my desk is Houston and Texas in general is most likely going to be looking at a continual upward trend. More of a gradual trend. We have been seeing a little bit of downturn as well, but a lot of that is due to, we have to remember, during the pandemic, or what everybody prefers to call it, we had an exceptional rapid rise in real estate. I mean, I know in the Houston area, we saw as much as 30-40% in a lot of areas in the Houston and surrounding area. What would you say you saw in the area where you're at, Greg?
Oh, at least that. Yeah. It's of course houses here are cheaper because people don't make as much. But what I have noticed walking around my neighborhood, homes that are for sale last a month or two, and I'm seeing a lot of out of state plates. I think people out west California are buying up, selling their houses for millions and paying 250,000 here cash and moving. So it's been a pretty good market here, actually.
Yeah, we're seeing a lot of that same activity. What I've noticed is the states that seem to be a little more business friendly seem to be attracting a lot more of the large businesses. I know Texas has had a big move here, and I'll just use Elon Musk, for example. I mean, he's got his SpaceX program here in Texas now. He's got his Tesla facilities coming here, as well as his Twitter, now known as X, is also moving here to the Texas area as well, too. And then there's major oil companies as well making a big move. And a lot of it has to do with businesses are going to look at, okay, where's the spot that we can go to that's going to be the most friendly for us to do what we need to do and not get taxed to death.
Yeah.
But with that said, let's jump into give people a little, I'm going to want to dive into this a little bit. And I know you're also an expert in this side of things as well, too, on what's going on in the world of interest rates and really kind of pull back the curtain so people can get a better idea of what's happening. I'm sure a lot of you have heard that the feds dropped the federal interest rate or dropped the interest rate that banks charge each other by 0.5 basis points last week on the 18th, on Wednesday. I know a lot of folks were, oh my gosh, the rates are coming down. The rates are coming down. What are we in the 4s now? Or are we in the 5s now?
Yeah.
And
fortunately it's not that simple. It all has to do with the bond yields, man. I think the last show we did, it was like a month and a half ago or so. I had stated that I think the Fed was behind the curve. They should have cut in July. So what's going on is the reason why you're having rates go up when the Fed's cutting because they were way behind. Bond yields on the 2-year, they were 170 basis points behind, which is 1.7%. So them just cutting 50 basis points still puts them 1.2% or 120 basis points behind. So what happens is, especially if there's panic in the markets, if people go sell out of high risk assets into bonds, it can raise the rates and still not be, so the rates can still go up 1.2% to just get to where the Fed marked it down to with the recent cut. That's why you can have rates go up like that. And it's unfortunately nothing you can do about it. It's the bond market, man.
yeah, and a lot of people think that just because the Feds cut the interest rates, that's going to cause a big change in what's happening in the 30-year fixed rate mortgages and 15-year fixed rate mortgages. And another thing that we saw happen after they cut the rates was the market got excited. The stock market got very, very excited. And what a lot of investors did is they said, okay, things are looking great. Let's go ahead and pull out of the bond market and let's start investing money back in the stock market because the lower short-term interest rates are going to be of a benefit for businesses.
Yeah.
Now,
it's well, they're hoping for the easy money to continue, but these cuts are kind of in the same economy we had in 2008. So I'm not sold yet on continuing upward for a long period of time, but we'll see.
yeah, I mean, I think in a lot of the issues that we're still having too is we still have a lot of inventory problem. The good thing is there's been more inventory that's come online over the past 6 months to a year. We've definitely had some slowdown, But when I say slow down, okay, so a year and a half ago, if you put your home on the market, you could have it under contract in an hour in a lot of cases across the country. Now I get people going, oh, my house has been on the market for a while. And I'm like, okay, how long has your home been on the market? Oh, going on a month now. That's
Yeah, like it's a long time. I remember in 2008, mine was on the market like a year and a half. Like it's a long I was stuck in a bridge loan for a while. Anyway, different topic, but
yeah, no, I mean, there's a lot has changed. And the good thing is because we're starting to slow down a little bit on the market side of things, I'm hoping we're going to see a continued trend with the rates coming down. I'm hoping we're going to start seeing a little more move in the jobs market as far as the stability with that. And I think the Fed has kind of got themselves in a spot to where they're in a catch-22. If they keep going with the higher interest rates, they're going to throw this economy in the trash.
Yeah. Well, they've already pretty much stated they're going to keep rapidly cutting. So they're going to have to.
And what I've been advising a lot of people is, can you still save money now on a refinance? Yes. I'm also advising people, if you have unsecured debt, such as credit card, such as loans that are unsecured, those are typically going to be at a much higher interest rate. It makes sense to look at and do an evaluation and go, okay, by getting a refinance, taking this money out to go ahead and pay down my unsecured debt, will I in the end achieve a much lower monthly output? And in the majority of cases, that's a substantial yes.
Yeah. And as we've talked about in previous shows, if you wait too long, you might miss out your opportunity. If your credit card keeps going up, your utilization, your scores might get too low to even do a refi.
Exactly. And that's something else that a lot of people need to understand. What's happening too is because the credit markets have definitely constricted over the past several years, they are cutting people's interest rates, or not interest rates, cutting people's credit ability, utilization, when they start seeing you stack up more and more unsecured debt.
Yep. Lowering your limits, which makes your utilization higher. Yeah.
Exactly. And Greg, please expand on that. The utilization. I know a lot of people still believe the old tried and true, well, if you have 20% or less or 25% or less on your credit cards, you're going to be okay as far as score.
Utilization is the amount you owe compared to what you have access to. So to keep the math simple, you have $1,000 limit. When you hit $100, after that, you take a little bit of a hit. $200, actually every 10% ladder, you take a hit. And what we're going to show you on some stuff here today is that there's actually a percentage that's even better than having them paid off, which I'll kind of explain when we get to that. But so what's happening is, say you owe $700 and the credit card companies are worried that you're getting into trouble. They lower your limit from 1,000 down to 700. Now you're maxed out. Your utilization went up without you doing anything wrong. So that's what I meant by when you start getting utilization higher, the credit cards are taking action as well. And the higher your utilization gets, the better you won't get as good of a loan if you're even able to refinance at that point to get out of the mess with your mortgage and your credit cards.
Oh, exactly. And in a lot of cases, when I show people that and show them, and some people get a little concerned, oh, well, wait a minute, if I do this, now I'm going back into a 30-year fixed rate mortgage. And then I show them there's techniques that we can do to where, okay, now you're saving, in some cases, I've saved people $1,000 a month in outgo. That's a substantial amount of money. That'll buy roughly about a week's worth of groceries now in 2024. But
yeah, some cases.
I can show them how they can take that money that they've saved and use a technique that will allow them to rapidly advance that mortgage. So they can literally take some of the savings that we've given them by paying off their unsecured debt and properly go in and prepay principal to eliminate tens of thousands of dollars worth of interest and take a 30-year mortgage, in some cases all the way down to 7 years.
Nice.
Now, takes discipline, but that's just something else when people meet with me, when we go through the process. If that's something they'd like to go into, I sit down with them. We meet face to face. I have a way to bring people into my office without them having to leave their home. And we sit down and we go over the techniques line by line. And I can easily show them on the screen right behind me. Here's what you do. Here's how you do it. And then they have a nice recording of that, and they can take the strategy that I've shown them and use that. And they are just amazed at, one, how much interest that they have to pay on a loan over 30 years, but two, how easy it is to eliminate a substantial amount of interest.
Yeah.
And with that said, I would like to dig into the credit part now. And the first thing I'd like to dig into is, this is a video that will be, I'll put it in the comment section after the show. This is a video I'm going to recommend everybody go and watch. It's a whopping 3 minutes and 31 seconds. It's going to show you how to do what's called opt-out. A lot of people are unaware, but your credit scores or your credit profile is being sold on a daily basis to the nice people up here. The telemarketers. We all love these telemarketers who call us, don't we?
Oh, sure.
Offering us all kinds of credit. Well,
yeah.
The federal government has just put into, or working to put into place with the spending budget for 2025, the defense spending budget for 2025, to include what's called stopping trigger leads. And what happens is, a lot of people are unaware. When you come apply for a mortgage or an automobile or a credit card, that creates what's called a trigger. The credit reporting agencies then take your data and they sell it to the highest bidder, like these nice folks behind us here, Greg, and they start telemarketing you.
Same thing happens if you're sued or file bankruptcy. You'll start getting advertisements about things like that as well. Yeah.
Yeah. But what people need to understand is, this is a simple process that was created a long time ago by the government. And there's a link in my video here that will take you right to the page you need to go to easily opt out. And here it is right here, opt out pre-screen. The reason I want you to watch the video is because if you do it incorrectly, you'll actually opt in. And if you opt in, you will not be a happy individual. Because on average, people, when they get hit with the trigger leads, is usually about 20 to 50 phone calls a day.
Yeah, I highly recommend this too. I have a link to it on my website as well. It's allegedly back in the day it helped raise your credit score. Now I'm not sure, but anyway, it's good to avoid the calls. Yeah.
And I'll put this down below as well. Well, let's dive into the credit part, sir. I'll let you kind of take center stage here, Greg, and dig into what's going on in the world of credit and credit scoring, and what people really need to do to put themselves in the strongest position to have a great credit profile.
Sure. Reason I decided to get into this is that's one of the biggest questions I have. What's my score? And I'll usually send them to the Experian app online, which is the only legit free one that I'm aware of, where you don't have to put in credit card information. And then of course they'll go to try to get a loan somewhere and it doesn't match. And as you can look there, you can see that there's so many versions of FICO, and it's nearly impossible to tell which one your lender's going to use. So, and even I don't even recommend paying for the scores, because it's probably not going to be the correct one anyway. Because again, it depends on your lender. But the newest versions there are 10 and 10T. If you go down to the bottom, it'll kind of tell us what they're actually changing. And for the most part, what they're changing is the trending parts of the scores. For instance, say you carry some credit card debt and you've had it for several years, but you've just basically just been transferring it back and forth to different cards and not making really any headway on it. So now with this new trending model, you're one of those ones that might take a hit because they're seeing that you're having a tough time paying your credit card debt down. You're kind of just floating on the water there, not making any progress. But I also brought that up because I actually discovered a new scoring model that I had never heard of. It's been around a bit, but called the UltraFICO, which that's on a different page. We'll get into that. And it also was triggered by you had sent me something with something they're doing on your end about, there you go, that. If you go down there and read, you'll see a part that says something about they're not recommending. It might have been up closer to the top there, John.
Yeah, and just so everybody knows, what this is when I pull your credit report for a mortgage, I'm going to get your credit scores from TransUnion, Equifax, and Experian. The credit company that we use also tells us with that score, is there a potential in all three of your credit reports for you to get an increase in your credit score? And it'll give us, okay, TransUnion, you can get 20 points. Equifax, you can get 40. Experian, you can get 30. If people want to get that raised because there's a big pricing difference between, say, a 700 credit score and a 740 credit score. And I can look at that model and tell the borrower, okay, Mr. and Mrs. Homebuyer, if I can run the simulator and it will give me a, hey, we think if you pay this down, this down, and this down, and do these other things here, we can do what's called a rapid rescore, and we can possibly get your credit score to that 740. It does not guarantee that it will get there. However, every time we've done a rapid rescore, I've always seen an increase, because I know 699 and 700 doesn't sound like a big difference, but when you look at the pricing difference between a 699 credit score and a 700 credit score, there is a difference, and it's worth 1 point.
Well, when you sent me that, that's what triggered this little episode here. If you look right under Merrick Bank Corp there, it says pay balance down to 288 or lower, but not zero. And what that reminded me of, and if I could remember the source, I'd quote it, but I'm always trying to educate myself what's going on. And I had read somewhere some time ago that the optimal rate to have your credit cards at to get the best score is at 8% of that utilization. So if you have a $100 limit, $8, et cetera, and just multiply it up. But so that right there kind of led me think, that's probably true then, because of course, what you find on the internet, you got to take with a grain of salt whether it's true or not, because it depends on what they're trying to sell you. But since you got that from an official source, and I read that, so I went looking around. So the next page with the FICO, it kind of verifies that as well.
Yeah, now this came directly from the folks that we work with in the mortgage side of things, from the credit reporting industry. And that's another thing I like about Greg is Greg and we've been known in the past to really dig deeply into a lot of things, because at the end of the day, we want to be able to offer people a solution and give them the truth as much as we can find it, so we can help them, whether it's for the mortgage, whether it's on the real estate side, whether it's on the credit side. And to be honest with you, this industry, I've been in it since 1999. It is always changing. And especially now with the internet, there is so much information out there that just isn't correct. I was dealing with an individual the other week, and we were talking about it, and he said, John, I know you mortgage people make more money on a 30-year mortgage than you do a 15-year mortgage. And I laughed, and I said, well, first off, I said, even back before they changed the rules, that wasn't true. I said, but now when they changed the rules after the last great mortgage meltdown, it doesn't matter what loan that I offer you or what loan you accept. We have to be compensated the same way. And that's just one thing. And that's another reason I'm glad I can bring this show to folks, because people really need to be educated on what's really happening when you're out there looking to buy or sell real estate, because there is a lot of misinformation out there. There's a lot of things that you can go down the rabbit hole on the internet, and there's plenty of, as I call them, www.mortgagecompany.coms out there that are not going to take the time to properly guide you through one of the biggest financial decisions of your life. That's buying and selling real estate.
Yeah.
Well, let's then go over to, we've also, here is, bear with me. Okay.
Yeah, right there at the top. This was interesting. Apparently, it's been around for a bit, but I had never heard of it. So that's one reason I like doing these shows. It kind of makes me educate people and myself. But there's something called an UltraFICO score. And if you read there, it benefits people that have lower scores or none at all. But you can add, but you're very good with your finances. You've had a bank account for a while. You've got money in different places. So you can basically add, as it says there, length of time your bank accounts have been open, recency and frequency of bank account transactions, evidence of consistent cash on hand, and positive bank account balances to produce what they call the UltraFICO score, which might help you get a loan that you otherwise couldn't get. So I thought that was, because there's a lot of people that they've been cash forever and they have good finances, but they avoid credit for obvious reasons. They don't want to pay 20 and 30% for things. But now there's also, if you want to, and I've already talked about the 10T with the trended data. That's one of the big changes they've made. And
well, that's something, just so people know about the trending data.
Yeah.
We're seeing that. Is it in my industry yet? No, but it's coming. And it is, the more I see the way things are moving, they're looking more over the trending, which what that means to you is like what I'm doing with the rapid rescores. Okay, we go pay down some accounts, and in a week, I can move your credit score up possibly 40, 50 points. Well, if the trending model takes over, that's not going to happen, because it's going to be looking for, okay, what is this person's trending history over a long period of time? And I asked this question, and I don't think anybody could answer it. And even if they could, the credit reporting companies, they probably wouldn't. So if that's the case, then if we're going with the trending model, if something happens to where, for whatever reason, the payment got 30-day late one time, does that trending model now then mean, if we don't have a history of a lot of 30-day lates, that the score will not drop so dramatically? Because Greg, you've seen, what's the score drops you've seen just on one 30-day late in your history?
Oh, it could be anywhere from 50 to 100 points, depending on what else you got going on. Yeah.
Exactly. So with that, yeah, there's some pros to the trending model. Yes. Are there some cons to the trending model? Exactly. But with that said, I think it's safe to say over the next coming few years, we're going to see a definite change in how credit scoring is done.
Mm-hmm. Yep.
And then also too, here's another one you wanted to share.
That is the actual website. You go to the top. If you actually want to add yourself to get an UltraFICO score, that would be at the top. You'd have in the browser where you go, or you could post it in comments or something for people later on. It's the exact place you'd go to voluntarily give your information to create an UltraFICO score.
What I'll do is, let me do this now. I will stick it here in the comments on Facebook here right now. So anybody watching on Facebook, there's that in the comments. And then once this show is finished, for anybody in YouTube, and I'll take this and put it in the comments as well. Anybody watching on YouTube, I will also add this in the comments section. I'll put it as the first comment, and I'll pin it to the top in the first comment. That way you'll be able to easily access it. Bear with me here. Okay. All right. I just got both of those put in. And then last but not least, This is talking about what amounts owed and what that really does with your credit profile.
Yeah, this was further information. If you go down, you're going to see a bold-faced sentence uh, or bold-faced print that talks about how paying this or paying the credit cards down. There you go. In some cases, right there, a low credit utilization ratio will have a more positive impact on your FICO scores than not using any of your available credit at all. So basically, having a balance, a small balance, can be beneficial instead of having it paid off completely at zero. So that kind of leads more to when I read years and years ago that 8% was the optimal amount to get the best score at that particular time. Now, it doesn't mean you have to carry the balance, but say you don't owe anything at all and you just want to test it and you get ready to go in for a loan, charge it up to 8%, let it go report to the credit agency and see what happens to the score.
Now,
There's
here's
three different
something,
sources that say it works better. So
and I can attest to that when I do the when I do the credit simulations for the rapid rescores now. People will ask me, well, I was going to pay that all off. And I'm like, well, according to this, the model of what it says to do not pay it off. Pay it to this balance. Once we help you get your loan, then I encourage you to pay it off. But we're trying to elevate your credit score so you can get the highest credit score possible, because at the end of the day, one of the major factors that determines what your interest rate is your credit score.
yeah.
And
Just
just so
I didn't really see
everybody
any
knows,
reasons.
we
I
use
didn't really see any reasons as to why, but I would speculate that it has to do with if they assume you have zero balances on everything, maybe you just got the cards locked up and never use them. So, but at least with 8%, they see that you use them and you pay them off. So it builds a credibility that you won't get yourself in trouble, is what I'm assuming why that works.
Oh yeah, no, it's been that way for a while. I know it's come down quite a bit since back in the day when it used to be, the 20%. And one thing that I advise people as well too, a way to kind of trick the system to keep a balance is the credit report, your credit card companies report your balances and history to the credit reporting agencies when they send you your bill. Back in the good old days, they sent it in the mail. Now, most people, everything comes on their phone or they get an email for it or they have it set up on auto pay. So, what you want to do is always keep your balance at the 8%, like you said, Greg, and pay it off every month, even though you're paying it off and it's a zero balance the majority of time, so you're not paying interest. Well, guess what? It's already been reported, because once you pay that off and you're starting in the new billing cycle, that next purchase that you make on that card gives you that 30-day window with no interest. You just have to be disciplined to pay off the total balance on that previous bill before the due date, or you'll get hit with the interest.
Yeah. And another little credit tip, I had actually a guy call me 2 days ago, or no, it was Friday, asking he was using his cards, but his credit score kept going down. He said, well, I thought we're supposed to use them. Well, he was running it up and then paying it off in full. So I was like, well, just log in before it's even due and then pay it down. That way it'll report to the lower balance. It's a little credit tip you can do for if you pay your bills online already.
Perfect. Well, Greg, it is a pleasure as always. We are here at the top of the hour. We've gone a little bit long, but we always tend to, and I really appreciate. Hey, Greg always brings great information, and that's why Greg has agreed to be kind of a staple here for us on Real Talk with Real Estate Pros. Typically at the end of the month, we decided to have the show for today because I've got another great show coming up with an expert who's going to be in the title industry on Wednesday, and really going to have a lot of great information for you all on what's happening in the world of title. If you've owned your home for a long time, a lot has changed since when you bought your home. And I'm going to have an expert on who's really going to dig into the details and let people know what's happening on that side of things. But with that said, Mr. West, can you please share with everybody how they can reach out to you and get a hold of you if they have questions on credit?
Couple different ways. I've got the website westcreditservices.com, all one word, no spaces. You can put in a consult form there or call me or text me 859-625-4546 and I'll get back to you pretty quick. That's my actual cell.
Perfect. Well, I appreciate it, Mr. West. Until next month, you have a great one, sir. And once again, I want to thank everybody. Please do me a favor. Like, subscribe, all that other good stuff. And please share this with friends. That's my direct text number up top there. If you know anybody that you think would be a great guest on the show, please send me a text. Let me know. I'd love to chat with them and possibly get them on the show. Once again, y'all have a great day.